What is going on? Let me hit record here. All right, what's going on? We've made it to another Tuesday Home Finance Hacks, and we're talking about ways you can get that interest rate down. Interest rates are honestly not too bad right now. I know everybody is still, somewhat lingering after the pandemic lows. And so everybody's like, oh, interest rates are high. When are they going to go back down? Right now they're floating around, the high sixes. They could be in the low sevens or maybe the mid sixes, depending upon your credit score. However, it's not too bad right now. They're in a range where you can go out there and find a home if you wanted to at a monthly payment that can fit in your budget. You might have to move a little bit further out from where you want to go, but it actually might be more advantageous for you to get started on that home ownership journey now rather than waiting until the environment changes with interest rates or with home prices, if that even happens. It's more likely it's going to happen with interest rates, not quite as likely that it's going to happen with home prices in terms of seeing those drops in the home prices or in the housing market. But in any case, this episode, we're talking about how you can get those interest rates lower. A few things that we're going to talk about. One is the loan program that you are selecting. So loan programs have a big influence in being able to move those interest rates. If you are, let's say, purchasing under a conventional loan, odds are you are going to have a higher interest rate than if you were purchasing under an FHA loan. Now, I'm not saying this is a coverall for every single FHA to conventional comparison. However, typically you will find that conventional loans have higher interest rates, but there are some perks with conventional loans, which is why some people do go for those conventional loans. I'm not here to get into all of that in this broadcast. We'll take care of that in another broadcast. But in this episode, we are just talking specifically about interest rates. So you're typically going to find those those higher interest rates with a conventional loan compared to a FHA loan. Now, if you're looking to go USDA or you're looking to go VA and USDA also have very competitive interest rates. So you could get VA rates that are comparable to FHA. You might be able to get a VA interest rate that is slightly lower than FHA. So again, credit is going to play a huge factor. You've probably heard it multiple times from me if you've been following this broadcast for any length of time. Having your credit score as high as it possibly can be is going to be huge in helping you to get that lower interest rate, helping you to save money on the cost of that interest rate, because interest rates have a price associated with them. In the mortgage industry, we call that discount points, which is what you pay for your interest rate. Most people don't know what discount points are, and we're not going to go through a lesson in this broadcast to tell you about discount points. We're just going to say that most interest rates have a cost associated with them. And so when you're looking at getting that 6% or that 7% or that 5% interest rate, you need to be asking, how much does that interest rate cost me? How much is it going to cost me to get that interest rate? And if your lender starts telling you a discount point, make them convert that into dollars for you, because you don't speak discount point language. That's what we speak in the mortgage industry. You need to know how much in dollars. You don't want to know, oh, it's going to be 1.5 discount points, 2 discount points. No, you want to know, hey, it's going to be $8,000 for you to take this interest rate. And that's what you can go and run with. And that's how you can make your comparisons. But in any case, the loan program that you choose, conventional, typically going to be a little bit higher than what you're going to find in FHA, and VA, USDA can be comparable to what you will find on the FHA front as well. So FHA really has some better interest rates comparable to what you will find in other markets, or in other programs that are traditional lending programs, the VA, FHA, USDA, and conventional. So with that said, now we're going to get a little bit deeper into some of the things that are going to dictate your interest rate apart from those traditional programs. And these are things such as down payment assistance programs, and we'll call them non-QM loans, non-qualified mortgages, or non-traditional financing is another way to say it. So let's get into the down payment assistance first. When it comes to down payment assistance, a lot of times down payment assistance will give you a different interest rate than what you would have gotten if you went through a straight FHA loan. For example, there are some down payment assistance programs that will increase your interest rate. So if you were to go and get 3.5% down payment assistance, which is enough to cover the down payment for the house you're buying, or you were to get a 5% down payment assistance loan, which is enough to cover the down payment assistance for an FHA plus an 1.5% for closing costs, then you might find that your interest rate is going to be slightly higher. This is not uncommon. It's very common for you to have a higher interest rate when you go with down payment assistance. So just be prepared for that. Now, that being said, it's not necessarily a bad deal for you to take down payment assistance if that's what you need to purchase the home, because if it comes down to you purchasing a home with down payment assistance and a slightly higher interest rate, or you not owning a home at all, I would say get the home, get the slightly higher interest rate, work on your credit score so that you can work on refinancing, getting that interest rate lower some point in the future, maybe 18 months in the future, maybe 2 years into the future. However long it takes you, work on getting that credit score great. So purchase the home now, start benefiting from home ownership now, benefiting from that equity and that appreciation now, benefiting from that amortization with a piece of every mortgage payment going toward paying down the balance of that loan, which is putting cash back into your pocket in the form of equity. Start benefiting from that now by going ahead and purchasing the home, even if it's at a slightly higher interest rate, if you need that down payment assistance. But always be working on that credit so that you can refinance into that lower rate as soon as you're able to. So that's the first thing with down payment assistance. But another thing with down payment assistance, not all down payment assistance programs come with higher interest rates. Some come with very comparable interest rates compared to programs that are not down payment assistance. So you might have a down payment assistance program that might give you a very comparable interest rate to an FHA loan that doesn't have down payment assistance, or a conventional loan that doesn't have down payment assistance. It all depends. And there's so many different down payment assistance programs out there that it's hard for me to really just get into the details of this is what you can expect, because it may be what you can expect. It may not be. So for example, I'm going to use a couple that I have personally worked with. So there is one program out there. I'm not going to say the name of this particular program, but it is historically known for having interest rates that are like 1.5% higher than what you would find in other programs, meaning that if the standard interest rate for a traditional FHA loan was 6.5%, if you were to go with this program, you might end up with an 8% interest rate. And that's just how it is with this particular program. Again, you could buy a home with an 8%, or you could not own a home and keep renting. But that would be your option. So what would be the better option? Save up for your own down payment, or look into a different down payment assistance program. Another down payment assistance program, and this one I will say the name of, is the Georgia Dream program for anyone who's looking to purchase in the state of Georgia. They actually have extremely competitive interest rates. I've actually seen many times, very frequently, where their interest rates are lower than the market norm. So what that means is that, let's say that everybody's paying 6.75% interest rate, or 6.75% interest rate. Georgia Dream might be at a 6% or 5.875% interest rate. So they might be, 3/4 or 0.75% less than what the market norm is. They might be a whole percent less than what the market norm is. So Georgia Dream is one of those down payment assistance programs where you can get some money to help pay down payment and closing costs, but you can also get a very competitive interest rate as well. You might be thinking, so what's the drawback? Well, your closing costs are going to be a little bit higher, because every lender that pushes a loan through Georgia Dream adds a origination fee onto that, or a broker fee onto that, because lenders have to get paid for originating your loans. And since Georgia Dream dictates all the terms and everything with that loan, they keep the loan, they house the loan, everything goes to Georgia Dream for that loan. The lenders get paid off of that fee that they charge you. So that fee is limited. It's not just going to be astronomical. However, your closing costs are going to be a little bit higher when you go with that Georgia Dream loan. So again, you just need to know what the pluses and minuses are so that you can work it to your benefit. You get that lower interest rate, you get some down payment assistance, but you're going to have some higher closing costs. And so now you need to go in negotiating with the seller potentially to get a little bit more money in seller contributions or seller concessions to help take care of those increased closing costs. So That's one of the things that you need to be aware of when it comes to down payment assistance. So we've talked about the traditional FHA, VA, conventional, USDA, and how with that conventional, which by the way, if you didn't know, conventional is a privately funded loan. FHA, VA, USDA, those are government loans. They typically are going to have lower interest rates than conventional, which is a private loan. Not to say anything's bad about the conventional. There are some great positives to the conventional, but you just need to be aware of that when it comes to interest rates, which is what we're talking about right now. So we talked about the traditional loans of just going the traditional route with those FHA, VA, conventional, USDA. We talked about down payment assistance and the wide variation that you're going to find when it comes to down payment assistance loans. With down payment assistance, that you get the money you need for down payment, but you're going to get a higher interest rate, or you get the money you need for down payment, you get a decent interest rate, but maybe you have increased closing costs. And it can vary so widely depending upon the program you select. And some states have state specific programs. Look into all of those programs, see everything that you might qualify for so that you can best compare to see which option is going to be the best option for you. So we talked about those two options, the down payment assistance. We talked about the traditional. Now we're going to talk about the last one. And that last thing is what you can actually do to affect your interest rate, and that is the buy down. So you can actually buy your interest rate down into a lower rate. And this is something that you may have the option to do with down payment assistance, or it might be limited with down payment assistance. But that's something that you have an option to as well. And actually, before I get to the buy down, I do want to back up really quick and talk about one more thing. Non-QM, because I did state that non-QM or non-traditional financing was a third thing that we were going to jump into. So before I talk about the buy down, let's talk about non-QM really quick. So with non-traditional mortgages, these are not as frequently used, but they are utilized for some individuals, particularly self-employed individuals who have a lot of tax write-offs. And so they don't qualify for the traditional FHA conventional financing, but they still want to purchase a home. Having that non-traditional financing or that non-qualified mortgage loan is an option for them. Those loans tend to come with higher interest rates, higher than your conventional even. Now, you do have some of those loans that can come with pretty decent interest rates. I have seen non-QM loans or non-traditional loans that come with interest rates that are very close to being comparable with what you will find with a traditional loan, a traditional FHA, VA, USDA, or conventional loan. However, the reason they tend to come with slightly higher interest rates is because they do come with an increased level of risk. That's because you're not typically utilizing the traditional methods of qualifying someone, which are more tried and true methods, if you will. When you're doing a non-traditional financing, let's say a bank statement loan, and I'll give you a few of them just so you know what I'm talking about. A bank statement loan, this is a loan that you can get based off of the income that shows up on your bank statements. So a lender doesn't look at your tax returns. They don't look at your W-2s. They just look at your bank statements to determine whether or not you can qualify for that loan. And they look at your credit as well. Another one is a 1099 loan. So rather than, again, they're not looking at your tax returns, they're not looking at W-2s, they're just looking at your 1099 and your credit to determine whether or not you can qualify for that loan. A profit and loss statement is another type of non-QM loan where they're just looking at your profit and loss statement for those self-employed individuals who are trying to purchase that home. So these are types of non-qualified mortgages. DSCR, this is a debt service coverage ratio loan, which is a type of loan for people looking to purchase an investment property. It is a no-doc loan, meaning that you don't have to show any income documentation. They do check your credit, but most of the home, the qualification, I should say, is based on whether or not the home will rent for enough to cover the mortgage. And if it doesn't, that can adjust what the terms are of that loan that you're getting. But all of those types of loans that fit under that non-traditional or non-qualified mortgage arena, these are going to be riskier loans, meaning that they tend to come with higher down payments. Typically, you're going to have 10% or more, sometimes 15%, sometimes 20%, but generally at a minimum, you're going to have a 10% down payment, and that's if you've got great credit. Whereas if you had a traditional loan with the FHA, VA, conventional, USDA, you might have as low as a 3.5% down payment, all the way down to no down payment at all. So I should say down as low as no down payment with the VA or USDA, or you could have a 3.5% down payment with an FHA. If you're a first-time home buyer, you could have a 3% down payment with a conventional. But even if you're not a first-time home buyer, you could have a 5% down payment with a conventional. So those are still going to be your lower payment options versus this non-traditional, non-QM option where you're going to start off at a 10% down payment. That's something to keep in mind. But again, we're talking about interest rates here. And so just plan that your interest rates with those non-traditional mortgages are going to be higher than what you will see in the other two categories we talked about, the down payment assistance and the traditional FHA, VA, USDA, and conventional as well. So those are the three. Now, what you can do to affect your interest rate, in addition to selecting the right program or selecting a program that you qualify for, another thing that you can look into is called an interest rate buy down. This is something that you can pay for yourself, or if you're able to negotiate, or you've got that great real estate agent that's able to negotiate for you to get some seller contributions or seller concessions, the seller can also pay for that interest rate buy down for you as well. And how that looks is that if you negotiate for the seller to pay for it, that means that, let's say the seller is willing to put $10,000 toward closing. That $10,000 can be used to buy down your interest rate. If you already have the money to pay your down payment and closing costs, that's great, because that $10,000 can totally be used to just buy your interest rate down as low as possible, which is going to give you a lower monthly mortgage payment. So that's the best case scenario, is for you to save up the money so that you can cover your own down payment and closing costs, and you can put all of the money that you are able to negotiate from the seller toward buying down your interest rate. That's the best case scenario. Now, the second best case scenario is if you don't have the money for down payment and closing costs, meaning that you have to use some of the seller's money to cover part of the closing cost. Then you go into that down payment assistance loan. And if your down payment assistance loan allows you to buy your interest rate down, then you might have some room there to put some of that seller contributions toward buying down your interest rate, because the down payment assistance is covering your down payment assistance. And with what you have left over with closing costs, maybe you're able to cover some of it, maybe the seller is able to cover some of it, and then whatever's left over, you can utilize that to buy down your interest rate, or you can just come out of your own pocket to buy it down as well, if it makes sense, because it all depends upon the interest rate environment that we're in. Sometimes it's to your advantage to buy that interest rate down, but other times it's not going to be to your advantage at all. So that's something that you want to look into. And when it comes to non-QM, a lot of non-qualified mortgages, you do have the ability to buy that interest rate down as well. Same rules apply. It's all going to depend upon how expensive it's going to be to buy that rate down, because there are times where, let's say you're getting a 7% interest rate and you want to buy it down to a 6% interest rate. There are times where that buy down might cost you $8,000, but then there's times where, just to get it down 1% from a 7% to a 6%. But then there are times where getting it from a 7% to a 6% might cost you $13,000 or $15,000. It all depends upon the market and what's happening in the financial market, in the interest rate environment, as to how much it's going to cost you and whether or not it's going to be worth it for you to buy it down at that time when you're looking to purchase a home. If it is worth it, and you can talk with the mortgage lender to determine whether or not it's a good idea for you to buy that interest rate down at the time. But if it is worth it for you, I highly recommend, if you're able to, negotiate for the seller to pay for that buy down. But if not, it still might be more advantageous for you to come out of your own pocket to pay for that buy down, rather than just taking a higher interest rate, especially if this is a loan that you're going to be able to stay in for a long period of time. So those are just some things to think about. I know I threw a lot at you, so go back, watch this over again, because it's super packed with a lot of good information in terms of what you need to be considering when it comes to interest rates. And this is not even everything. I only scratched the surface, and it's hard to even say that I scratched the surface, even, because it gets so much deeper when it comes into interest rates in terms of how you can determine whether or not a buy down is right for you, and actually giving you the equations and the math problems so that you can determine whether or not, how long it's going to take for you to break even from paying $8,000 to buy your interest rate down 1%, showing you how you can determine that for yourself, and how you can determine whether or not how low you're buying your interest rate down is going to be worth it for you, or if you should wait until interest rates drop even more, because it may be the case that when you buy your interest rate down, that the level to which you're buying it down is the interest rate that you could stay in for the next 4, 5, 6 or more years. Or it might be that, you know what, you're only buying it down to a level to where you're going to be considering refinancing in another 2 or 3 years. And is it going to be worth it with them? Like I said, this goes so much deeper than what I've just discussed, but what I've given you is a lot of information for you to consider when it comes to interest rates. But I don't want to leave without telling you this one important thing. Regardless of what direction you choose, whether it's a non-traditional loan, a down payment assistance loan, or just traditional financing, always ask, as you're shopping mortgage lenders, as you're looking at different interest rates, ask your mortgage lender, your mortgage loan officer, how much is that interest rate going to cost me? How much does that interest rate cost me? You need to know how much it costs you. You don't need to know discount points. You need to know dollars. Don't have them doing the math. They shouldn't have you doing the math, rather. Have them do the math and convert that into dollars for you. They've got the sheets most of the time right there where they could just tell you what the dollar is. So make sure you are asking your mortgage loan officer, how much is that interest rate going to cost me? And make sure they tell you in a dollar amount. And that way you can accurately and appropriately compare one program to another program, or one interest rate to another interest rate. You know, hey, I'm getting this down payment assistance, but I'm gonna get this interest rate over here, and this interest rate is gonna cost me $6,000, $10,000, $12,000, whatever it is. And are you able to negotiate that from the seller, or do you even have that amount of money to be able to pay on your own? Or do you need to take that higher interest rate, which will lower your closing costs, so that you could actually get the home and look to refinance later? So that's what I have for you. Thank you so much for taking the time to tune in. I truly enjoy talking about this stuff. I could talk about interest rates, financing, the mortgage market all day, but you don't want to hear me talk about it all day. So hopefully this has been beneficial for you, especially if you are in the market looking to purchase a home. So make sure you check back in on Fridays. Greatest Asset Community Podcast will be dropping another episode. It's going to be great. You're going to want to tune in to hear it. Trust me, it's going to be really, really good. So that's what I have for you. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you next week.